Why is it that you can look it up and this dude has a 19% tax rate? Okay? Why? That is because rich people like Jeff Bezos have investment income. Okay? They have investment income. And this is taxed much differently than earned income. Earned income is when you go out, work for somebody else, and then, or start a business, and then that's what you're paying taxes on. Okay? This investment income is usually dividends and capital gains. Dividends are when you say buy a stock and then this stock will give you dividends, okay? These dividends can either be qualified or unqualified. If they're qualified, they get lower special tax rates. If they're not qualified, then they get taxed at your normal tax rate, which would then be the tax tables that I just explained earlier. What makes a dividend qualified is too much information for this video. But anyways, richer people who get dividends, if they're qualified, they pay a lower tax rate. If they're not qualified, they'll pay the regular tax rate that you look at when you look at a tax table, okay? Depending on, again, how much it is. So I would say that most richer people's investments that give dividends are qualified, okay? So another thing is capital gains. What is a capital gain? Let's say you buy a stock for $100, it goes up to $110 and you sell it, okay? Your capital gain is $10. So if you've only held that stock or investment, whatever it is, could be a bond, okay? But stock's just the easiest one to think of. Could be a piece of real estate. Anyways, capital gain. You buy something, it goes up in price and you sell it, the difference is your capital gain. So back to our example, it was $10. Now, depending on how long you held this asset, stock, real estate, bond, whatever, will determine whether or not you pay short-term capital gains tax rates or long-term capital gains tax rates. And what's the difference? Short term is anything held for less than 1 year. Long term is you have to hold that asset for longer than 1 year. So if you've only had the asset for a short term, so less than 1 year, you will pay normal tax rates that you look at and see on the tax tables, just like an unqualified dividend. If you held that asset for longer than a year and then sold it, your capital gain is then taxed at capital gains tax rates, right along there with qualified dividends. They're treated the same, okay? So what are the capital gains tax rates? Well, Google has the answer. Don't you just love that? Google's got the answer. Anyways, the top capital gains tax rate, doesn't matter how big your capital gains is 20%. That's it, okay? There is very small situations in which it will go above that, but that's too much for this video too. So, Jeff Bezos, right? Owner of Amazon, goes out, sells some Amazon stock. He probably has a really large capital gain in that stock. And I'm sure he's held it for more than 1 year. So what happens? He gets taxed at 20%. Now, your thought is that bad? Well, let me read it to you. Capital gains tax rates are long-term. Long-term capital gains tax rates for anybody whose taxable income is $78,750 or less than $78,750 is 0%. The average household income in America is about $60,000. So if you're someone who makes the average income in America and you have a long-term capital gain, you do not pay any tax on that capital gain.